Hi, my name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings plan. Thanks for checking in today on our third quarter Student of the Market update. We're going to take a look at what's happened in the first half of 2022 here in the markets, and with that, we'll get started. So, as we covered last month, it's been a remarkable and historical start to the year. I wish I could say that that was in a good way, but it's been a historically poor start to the year for both stocks and bonds, which is atypical, and it's been something that's been really challenging for investors that are in a more traditional, balanced, diversified portfolio. So if we look at, the start to the year, again, going back to 1926, we're down over 10% on the bond side, significantly worse than the previous worst first half, which was 1994, being down only 3.9% through the first half of the year. If we look at the other side of this slide, over on the stock side, not much better news. The third worst start to the year for stocks going back to 1926, with only 1932 and 1962 having been off to a worse start for U.S. stocks. Interestingly, those 2 years both bounced back the following 6 months, but plenty of periods shown here where it was a mixed bag or a poor start led to even lower 6 months later. So overall, a really challenging start to the year. Again, especially for investors in a balanced, diversified portfolio, there hasn't really been anywhere to hide. So, certainly a challenging start to the year. Now, what else are we seeing, and what strategies can we put to work as an investor, and especially an investor in our retirement plan portfolio? Let's take a look at volatility. So if we look at volatility year to date, this is a chart we've looked at in our previous updates. We've gone ahead and updated this chart for the first half of 2022. And what we see here is, again, continued volatility. This chart shows you greater than 2% market moves in the S&P 500. So far through the first half of 2022, we've had 26 of these days, putting us on pace to a similar number as in 2020 when the lockdowns were just taking place. Thankfully, nowhere near the great financial crisis numbers. And as we've covered previously, this uptick in volatility, if we look at what the market is telling us, it's telling us that there's a lot of uncertainty out there and the market is trying to find direction. We have geopolitical risk, we're in a midterm election year, we have inflationary pressure. All of these things are coming together to make it so that it's really challenging for the market to find direction. And as investors, we're feeling that in the form of this uptick in volatility. So, let's talk a little bit about this election cycle and what has history shown us in terms of what we may be able to expect in a midterm election year. So, unfortunately for us, midterm election years have been historically poor for investors relative to the other types of election cycles. What I found interesting here, if we look at this, if we break it out into first and second half of the year, we see historically, going back to 1926, the first half of midterm election years has been almost flat for investors on average, about 30 basis points. Now, granted, that's not a huge sample size. 95 years, we cut it into fourths, about 23 and change of these cycles. But pretty consistent that the first half of these midterm election years has been, poor for investors relative to the second half. It'll be interesting to see if that holds, and that trend has been different in these other types of election cycle years. So, when we look at this, we've talked a lot about the poor start to the year and about how challenging it's been for investors. And I think it's important to remind ourselves as long-term investors that it's easy to get caught up in recency bias and to really get caught up in the moment. So it's helpful every once in a while to take a big step back and look at what the market's done since 1926. What has history shown us? Well, it's shown us that if you were lucky enough to be around in 1926 and had $1,000 to invest, that you'd have roughly $11.3 million today. And that's including our recent 20% down move in U.S. stocks and this bear market that we're in. So, again, it's helpful to make sure we do take that step back, that as a long-term investor, as a retirement plan investor, that we look and see, okay, what has being disciplined over a long period of time as an investor, what has that done for us if we had a plan, if we were disciplined and we stuck with it. And I think, again, it's important to look at this chart and take some comfort in the fact that we can take a step back and have that longer term view as a retirement plan investor. So with that, I'm going to put put some important disclosures up on the screen here briefly. But as we discussed last quarter, a lot of uncertainty in the market. Challenging period year to date for investors, and through the first half of 2022. But thankfully, again, history has shown us that if we have a plan, if we stick with it, and if we're disciplined, that can help us as a long-term investor, really stick with our game plan, and that has proved to be a successful strategy over long periods of time for investors. So with that, thank you for the opportunity to check in with you with this market update. Again, the goal of this series is to help inform the important financial decisions that you're making, both within your workplace retirement savings plan and beyond. So with that, thank you again for your time, and we'll look forward to checking in with you next quarter. So long.